The S&P 500 stuck in the danger zone, trapped between 2,600 and 2,650, which is the range the market broke below as it spiraled towards new lows. And despite the run off those lows, stocks still might not be in the clear. Bob Pisani is at the NYSE with more. Hey, Bob.
Hello, Melissa. The markets have come a long way since bottoming on December 24th. The S&P 500 has recovered almost 3/4 of the losses we saw in December. But in the last 2 weeks, it's had a hard time getting decisively over 2,650 and regaining that last 100 or so points to get us back to those early December highs. Now, there's three things that have shown to be consistently moving markets and earnings perceptions. The first is perceptions that the Fed and other central banks are becoming more dovish, that not only will they not raise rates, but they may also return to stimulus mode if they have to. The second is, of course, hopes for a positive trade outcome. And finally is slower global growth. And today, Nvidia and Caterpillar sent a message to the markets that even with the declines in December earnings estimates, the numbers for 2019, the earnings estimates, are still too high. Now, remember, more than 40% of earnings in the S&P 500 occur outside of the United States. So when both of these companies talk about slower global growth, it's a big issue, particularly for industrials and for technology. But how much slower is global growth? That's what's hard to figure out. First quarter earnings estimates have already come down dramatically from 8% at the start of October to below 2% today. This is the first quarter. Now, the battleground is now between those who believe earnings will stay low but positive for the full year and those who believe that an earnings recession is likely, that is, 2 consecutive quarters of negative earnings growth. Now, one positive development, even as most sectors drooped, banks opened weak and they quickly rallied. The big names, JP Morgan, Bank of America, a lot of the regionals like Comerica and Zions were all ending in the green today. The bank ETF, the KBE, has rallied even as other sectors have moved sideways in the last week. It is the biggest sector gainer for the month. The KBE is up 15%. It's now sitting at its highest levels since December. So, Melissa, maybe a little rotation going on here into the banks and maybe a little bit out of industrials. Back to you.
All right. Thanks, Bob. Bob Pisani at the NYSE. Our next guest is Wall Street's biggest bear. He says, get used to life in the danger zone. Let's welcome back Chris Harvey, Wells Fargo Securities Head of Equity Strategy. Chris, great to have you back.
Great to be back.
Nice to see you. Bob made a number of good points, but I think one of the most salient points that he made in this earnings context is the fact that even if you don't extrapolate Caterpillar and Nvidia to the rest of their sectors or the rest of the markets, the earnings report and the guidance really just underscores this notion that perhaps estimates are just too high across the board.
And I agree with that. I think estimates are too high. We expect mid-single-digit returns for the S&P 500. We're on the lower end. What we want to see is we want to see companies lower guidance. What we want to see is, for the first time in a while, we're really seeing value in a lot of the value stocks. Karen, I think you're probably like a kid in a candy store for the last couple of weeks, because value companies are really looking interesting to us. And companies with really bad guidance that are reacting to the market, we think as we move forward, you can start to step over it. And that's the real opportunity. But we don't want you to rush into it. It's a walk, not run type situation. Lower the guidance, have the market react, and then we think you can get involved in those names.
How do you view what would a good buying opportunity entry point be in this market? I mean, what are you looking at? A PE? Are you looking at a level?
We're looking at PEs. We're looking at is a company buying back stock? We're looking at forward multiples. We're looking at book value. We're looking at a myriad of issues. But really what we want to see is we want to see where sentiment is just horrific. We want to see the company lower guidance. We want to see the stock down on that guidance. And then we think with all that bad news, you can make money going forward, because for two reasons. One, again, you're either going to step over lower guidance as we move forward, and if things get worse, you've already beaten the rush. And so on a relative basis, you're going to look a lot better than other companies.
So looking at some of the things that have really gotten beaten up, that have lowered guidance already, the stock's gotten killed, like a FedEx or some others in the space. Is that an area you'd want to be in?
So we have a model portfolio. What we did last week is we added to some of the industrials, we added to some of the tobacco names, and that's where we're starting to find value. At the margin, that's where we're rotating. We've been up in quality and down in risk, but slowly but surely we're adding some value and we're adding some risk to the portfolio. We want to do it again after the news is out, and we think that's a pretty good risk reward.
Chris, how do you factor in any potential deal with China on the trade front?
That's all gravy. If you get something positive, a lot of these beaten up stocks are going to react. What we've seen most of the pain is on the consumer, not on the consumer side, but on the cyclical side. If you get any positive news out of China, again, the economics won't move, but the stocks will move. And so you're sitting on a situation where you have that to the upside, and that's not even baked into our view.
In terms of adding to industrials in other sectors, where are you taking away from? What are you lightening up on?
So we've been taking away from, so in industrials, we haven't liked transportation, but we have liked cap goods. Again, we're doing this rotation. And then when you look at some of the technology spaces, we've liked software, we haven't liked semis. Now we're starting to see more and more value in semis, but we're not ready to step. We're starting to line that up. And so we're doing a lot of intra-industry trades, and we're doing a lot of one-off type trades, because some of these situations are very idiosyncratic. And so we think it's more of a stock picker's market this year than it was last year.
Is this the most active that you've been in this model portfolio? I mean, it sounds like a constant.
We're starting to rotate. At the beginning of this year, we had 9 buys, we had 3 sells. We were pretty active this year, and we're starting to rotate. We're seeing the opportunities begin to rotate. Again, you have 2 years of value underperforming. You had a horrific fourth quarter. We've been saying that value companies have really been a proxy for risk. Now you're seeing value as an opportunity. You have to tread lightly. We want those expectations to come down, but as we go forward, that's where the value is, and that's where the opportunity is.
Chris, good to see you.
Good to see you, too.
Coming by. Chris Harvey. All right, Tim, you're a value investor. Where do you go?
Yeah, I think Guy's ego is writing checks his body can't cash, by the way.
That's a Top Gun thing, Mel.
FYI. Look, I do think that value in the industrial space, I've said this over the last 2 weeks, 2 months, possibly 6 months, is more than flagged. In a global environment where we have priced in essentially negative PMIs around the world, this really comes down to, is the Fed truly on hold? And can we actually get a trade deal soon enough that we can actually still experience some of this late cycle stuff? I feel very comfortable with FedEx. I feel very comfortable with other names that are trading at trough multiples here because, in fact, they're giving us fresh numbers, and those are companies I can own.
You know, what's really counterintuitive to me is that if we get this deal done with China, we all thought that it's going to be a positive. But by its nature, the U.S. wants to take something from China, right? That's the whole idea of the trade deal. So at the end of that trade deal, it's got to be more of a negative for China. So counterintuitively, I think that you're going to see China growth actually impeded once we get the trade deal done.
Let me just push back on that, though. One
Sure.
of the things I think weighing most heavily on this market is the uncertainty of a China deal, right? That we won't get one. And I think that if we are able to have some clarity, even if it's punishing to China
Sure.
and causes some, pain there, which ultimately would cause some pain here, taking away that uncertainty, I think, would be such a big positive for the market.
No
The net
question,
of
and
the
you
two
sell
is
that
up.
pop.